But why do you think it is that when you say the economy is improving and President Biden says the economy is improving, that a majority of Americans outside of this building are not buying it?
So here's the thing. When we walked into this administration, the economy was on a tailspin. That is the fact. Because of the last administration, because of the Trump administration, because of how they dealt with COVID and the pandemic, because they didn't have a comprehensive plan. The president came in, he passed the American Rescue Plan, which was able to get the economy back on its feet, which was able to open up small businesses were able to open up, schools were able to open up, and we understand what Americans have been feeling over the last 2-3 years. It's going to take some time. We get that. It's going to take some time, but it does not take away how we have seen the economy getting back on its feet. We actually had to fix the problem that we saw that the last administration left us.
Meanwhile, women and girls apparel up 1.3%, men's and boys apparel up 5.3%.
And remember, this is Bureau of Labor statistics year over year. But what's important to remind you, you may look at these numbers and go, okay, 5% for cookies, 3% for food. That's on top of the increase, on top of the increase, on top of the increase of the last 3 years. So you're paying 3% more on what you're already, it feels like 15, 20% more. You go to the drive-thru, you go to the grocery store, everything is exceedingly more expensive, and it continues to go up. It's like, oh, you gained weight this year, Will, but just a little bit less weight.
All right, guys, so you seen that, you heard that. That is Affirmative Action Press Secretary Karine Jean-Pierre essentially blaming the Trump administration for why there's a disconnect between how voters feel about the economy versus the narrative, the propaganda coming from the White House, the Biden administration, okay? She's basically saying, well, it's Trump's fault. Right? It's Trump's fault that voters feel like that the economy is bad and we have cleaned up the economy. Therefore, you should give us credit for the economy being good, right? That's essentially the argument being made by the Biden administration. And for this video, I actually want to have a special guest join me to discuss why we're seeing this difference between how voters feel versus what the Biden administration is saying in the current state of the economy. So without further ado, I want to introduce my special guest, Mr. Colin Plume from Noble Gold, to discuss the current state of the economy and why there's a disconnect between what voters are saying, what people are feeling, versus the Biden administration and what they're saying. The Biden administration has been touting great economic numbers, right? They're claiming that everything is great. Okay. And when we look at some of the headline numbers, and these are government numbers, okay, this is coming from the government. This is not me. Okay. But if you look at core inflation, it fell to 3.5% in October, down 5.5% in September. When it comes to GDP, it increased at an annual rate of 5.2% in the third quarter, which, I mean, that's pretty great. Okay. Now, again, a lot of that, is tied to summer travel, people traveling after the pandemic. Now, the Biden administration is claiming that prices are falling. Now, when it comes to some goods, there is some truth to some of these claims, as durable goods have dropped 2.6% from the peak in September 2020. Used vehicles, auto parts, furniture, seeing deflation. And this could be due to reduced consumer demand, Fed rates, hiking rates could also be a factor. Normalizing and smoothing supply chains, increasing supply could also be a factor as well, too, in regards to seeing some goods and price deflation. Now, again, there's a disconnect between some of the numbers that the Biden administration and the government is citing versus what consumers are feeling. Because despite these numbers, right, when it comes to the average price of food since April 2021, food prices have jumped 20%, which is causing a lot of people to feel the pain at the grocery store. Americans are going deeper into debt. Average credit card balance has increased 15% from last year. Credit card debt has reached a total of 1.08 trillion, which is the highest ever. Now, presumably, this is because of persistent inflation. 60% of adults say they're living paycheck to paycheck. Americans are saving less money. The personal savings rate has fallen to 3.4%. The historic normal is about 7%. And Biden's job approval rating remains at around 37%, which is basically a historic low for him. And his approval rate on the economy is kind of leading that with 32%. So my question to Mr. Plume is, why do you think that we're seeing a disconnect here between the Biden administration and the numbers that they're citing versus how consumers are feeling about the economy?
Well, the big number that sticks out that you mentioned, and by the way, it was a lot of good information there for people to digest. And people don't always talk about core inflation, but the number that sticks out to me is just the credit card debt, over $1 trillion. The idea that we've broken through an all-time high in credit card debt, and why would someone want to put money on a credit card at this point unless the cost of their everyday goods, the things that they need to buy, have gotten beyond what they can actually afford? I mean, that's what we really have come down to. And in today's economy, I think that what we're looking at is that another number that they tout is low unemployment. But if unemployment is below 4%, like they claim, then why would people have the credit card debt the highest it's ever been? It doesn't make sense. Plus, with interest rates being higher, the rates are higher than we've seen in many, many years. I mean, average credit card rate right now is, I think, 23, 24%. And then some of them go even higher for first-time creditors. They could be in low 30% range. So, I mean, these are astronomical numbers for credit cards, very difficult to pay back for anybody that's not making $1 million a year. It's hard to get caught up when you have a 30% interest rate. If you analyze that out, it can become pretty scary. So I think when you look at the numbers today in the day-to-day living, is that everything has gotten way too expensive to keep up with what people are making, number one. Two, they don't have, I think a big part of what's happening today is really financial literacy. People they don't really consistently understand what's coming in and what they have to live on. And a further truth of that is that they were talking about over the Cyber Monday and all this, that a lot of the purchasing was done on credit or in ways where people could push the payments. So the idea that credit card debt's an all-time high, then you have people that feel the need that they have to buy basically crap on Cyber Monday. They have to spend money. They have to keep up with the Joneses. So they're doing layaway plans on stuff that they really don't need. It's a further indication that our education level in this country on what's really important is not where it needs to be. And a lot of it starts early. We don't teach it in schools. It's not a big part of our education process, but we've really put ourselves behind the 8 ball. And because we've shipped everything overseas, everything is made in China and Vietnam, and all the products that we use day to day are all made over there. We don't make anything here. We've become this really expensive consumer economy where we're just consuming. And that's really put us in a precarious situation, coupled with the fact, and as you know, if you look at the debt clock, we're at $33 trillion in debt as a country. So you have personal debt at an all-time high for consumers, and then you have this unbelievable government debt that we can't even pay the interest on. We can't even cover it. So we've created these really scary situations, and eventually we will have to change the way we're doing business. China eventually is going to say no more debt. They're not going to carry our bonds anymore. We're not going to be able to do this forever, because there will be a number, and I don't know what the number is, but there is a number where the world just says enough is enough. $33 trillion in debt. I mean, if you go back 15, 20 years ago, we were a few $1 trillion in debt. Now we're, obviously got up many times from there. So we're in a really bad position as a country and as individuals where we're just spending way too much money.
Yeah, I agree with you. I mean, this is stuff I talk about all the time on my channel in regards to spending and financial literacy. What you're saying is that people are planning on going into more debt in the holiday season. Okay. And that is, I think, kind of driving some of these numbers that we're saying in the economy, is people still continuing to spend money. And that could be the reason why you're seeing some of the GDP growth that we're seeing. But one thing that you mentioned is interest rates, and all eyes are on the interest rates, whether you're talking about the stock market or the housing market or basically any market, really. I mean, interest rates seem to be king right now in regards to whether or not, things are going up and down, except not so much maybe in the housing market, because we're not seeing the conditions that indicate that we could face a housing collapse like a lot of people have been predicting, despite the fact that interest rates are elevating and elevated, and it's confusing to me. I have no idea what's going on. I've never seen anything like this. But the current federal funds rate is around 5.33%. The current mortgage rate is about 7 to 8%. The median home price is around $414,000, according to Redfin. Home prices are up month over month, 0.7%, and they're up year over year. Housing inventory, 1.55 million houses for sale, okay, which is down 8.7% year over year. So what you're saying is that there are less houses for sale. However, prices are going up, but interest rates also are
double.
Yeah, exactly. So it's like none of this is making sense in regards to the housing market. And a lot of people are wondering what the heck is going on and why are we not seeing housing prices drop, or conditions like we've seen in 2008, 2009, 2010, we that indicate that, hey, we could see a fall in housing prices.
Because we've been misled about what the CPI actually is for so long. They've kept the CPI, in this country, they would always report 2%. And this is kind of a long-winded answer to this real estate question. But the reason that we haven't seen housing prices drop so much is because they've lied about the cost of labor and the cost of goods. And the reason they've done that is to keep, there's a lot of people that have made a lot of money on cheap rates. But if you think about real estate, for instance, you have two very unique things happening. You have a lot of people that didn't make the same mistake they made in 2008, and they actually locked in a 30-year mortgage. Mm-hmm. Now, there are people that didn't. There are people, unfortunately, that didn't, that still kept, and it baffles my mind, because I was actually talking to someone recently that there's a lot of debt. Homeowners were taking 5-year notes. So they were taking 5-year notes at 2% instead of locking in 30-year money at 3%, which, by the way, like, they're kicking themselves now, because a lot of that debt's coming up next year or the year after, and it's very unlikely we go back to those rates anytime soon. So there is a lot of that debt. But for the people that have that 3% mortgage, the 2.5%, 3.5%, even 4%, they're probably not going to sell, right? They're not going anywhere. Those people.
Why would you?
They would never sell. So you have all these homes that are never probably going to hit the market until somebody dies or they get a divorce and they're forced out. So you have all that debt. And actually, I was reading this story over the weekend that because of what's happening in the real estate market, divorced couples are having to stay in the same house together, which, by the way, that is pretty interesting. That's a whole reality show unto itself. Yeah. It's having these two people that hate each other having to share a home. I mean, that's a whole thing I want to get into more, but maybe not for this show. Yeah. So you have those people, they're all stuck. But then the real issue is that the cost to rebuild the numbers are finally coming out.
Yeah.
Okay. That's the first thing. So it's, and I'd always look at these houses in these states and I go, how could a 3,000 square foot house anywhere, how could they sell it for $75,000? Yeah. And you'd see them. How could you build a house for 3,000 square feet for $75,000? It's because the cost of labor and everything is it's caught up. You can't build a house for that. So now the cost to build homes has skyrocketed. Also, nobody wants to do those jobs. It's literally one of the biggest careers that people leave is construction. So you have this shortage of workers there. So you have all these new houses that they want to build are costing way more than what they cost in the past. They've never seen these kind of prices for a new home build. So you have this idea that with interest rates doubling, that the housing prices would drop, but the cost to build is so high. So you're right. It's this unique situation that we never had because the numbers are finally becoming accurate. We're finally getting in a more that what's happened today is more accurate. And it's a big problem of what we've done over the last 20 years is with the Fed is that we should have moved interest rates much earlier. If we had moved interest rates and had a more normal economy, that we wouldn't have run into this predicament that we're in right now. But now we've kept them cheap for so long that we're dependent on it, right? And we're dependent on this cheap debt. And that's the real position we're in. And corporations are dependent upon it. You know, and think about it. I was talking about like Christmas and all that. Like, how many times have you heard where they say like this business lives on Christmas or lives on the holiday? I mean, there's all these retailers that live on the holidays. Well, let's dive into that even more. The items that people are buying during that time, most of them aren't even made here. So you have corporations that, yeah, they're taking a piece of the product because they made some plushy toy, but actually the real money is being made overseas where they're making that product. So we're in this paradigm where we've attached ourselves to having products made overseas for cheap. We've attached ourselves to cheap debt. And now the whole economy is going to blow up in our face. And that's really the truth of what's happening. And it's taking a long time to happen. But right now we're in that predicament where we don't make anything well. We're just a consumer economy. And without ingenuity, without us creating new businesses, without us having that engine here in the US, which the Biden administration is not a strong proponent of, if you don't have that ingenuity here and we don't start to bring a lot of those things back, it's just going to get worse. It's not going to get any better. Things are going to continue to become unaffordable, and we're not going to be in the best position as a country. And a lot of it has to do with the idea that we do have to give control back and give incentives to entrepreneurs and people that create jobs and that can hopefully get us out of this mess. But the idea that the government and more spending for the government and these programs that we're creating are going to help, they're not. I mean, look at what happened during COVID. During COVID, when they were giving people money, it was actually people were paying off their credit cards for a short amount of time. And everyone's like, oh, this is great. People got out of debt. 3 years later, we're in the worst debt we've ever been in.
Yeah.
As consumers and as a country. And the idea that everybody was clamoring to give people money, that would help, it actually backfired. And now that's where we are today. We're in a situation where, you know, and I remember people telling me they were getting like $1,000 a week. They didn't even make $1,000 a week and they were getting 1,000.
Yeah.
And so we created this situation where it didn't work. We tried to bail everybody out and it didn't work. It just created more debt. And we've seen it, you know, we're in the debt right now. And so we're in a really bad position. And that's why, you know, you have these situations, as you said, I've never seen anything in the real estate market, is because we've artificially manipulated the numbers as a government for so long that now when the true numbers come out, nobody can make any sense of it.
Yeah, no, I agree with you. And again, the consequence of all that money spending has been the inflation that we're seeing. Right. Now, again, you know, the government numbers suggest that inflation is coming down again, hovering around, you know, 3-4%. Now the target is 2%, and Federal Reserve Chair Jerome Powell, he, you know, has paused interest rates hikes. However, he suggests that, hey, you know, they may not necessarily be done, but clearly the markets are not buying into this because we've seen a bull run that suggests that maybe rate cuts could come in 2024. Now, me personally, you know, with the election coming up, you know, the Biden administration trying to make the pitch that the economy is great, you know, I wouldn't be surprised if we see a rate cut, you know, maybe during the summer, right, in 2024, just in time, right before the election, maybe to kind of juice the market a little bit, juice the economy a little bit with lower interest rates to make it a little bit more favorable for the current guy in charge, or maybe not so in charge. But, you know, with that being said, the markets are calling Jerome Powell's bluff. They're saying, look, we think that you're going to cut interest rates. And you're saying that the markets are shooting up to new highs. You're saying gold shooting up to a new high. What do you think is going on with gold? Because gold has reached an all-time high for this year. It's been up, about 10%, 14% year to date. We're seeing some movement in the marketplace based off this Fed interest rates pause and speculation in regards to what can come next.
Yeah, I mean, I think a lot of it has to do with alternative money. I think because Bitcoin's also up a lot.
Yeah, I forgot to
And so
mention that.
you're looking at people that are fed up with our currency because, at the end of the day, the banks are offering these higher rates now, finally 5%. But they're only offering 5% because nobody wants to keep money in a bank, number one. And two, they really need the money. They really need money in banks. So that's why they're offering this rate temporarily. I do think those rates will go down next year because I agree with you. I actually think they're going to cut rates in the first quarter of next year.
Wow.
But gold is reacting to that because gold is in high demand. Also, China has been buying so much gold this year. And I've been reading a lot about this and looking into it. And China also mines a tremendous amount of gold. The gold that they mine, they never sell. It never leaves the country. And it's not properly audited. The public doesn't actually know how much. So there's reports, I've seen interviews where people talking that they think China owns 5 or 10 times more gold than what's actually reported. And, if you look at the strategy there for them buying gold, it is an inflation hedge protection play, right? Because China has had very similar problems as we've had. Mm-hmm. They've had a lot of real estate problems. Their largest real estate company, their commercial company, went out of business. They bet on massive growth and growth in the housing market, and it didn't really come. And they've had higher interest rates, so they're taking a pause and they're moving in a more selective way and a more stable way, and buying more gold and silver. So yeah, you saw a massive bull run over the weekend in gold, and that's usually when things are starting to happen because. Yeah. After market trading in gold, after the markets closed on Friday, I mean, gold was up almost 4% in aftermarket trading over the weekend. That means there's a lot of money moving into gold. And yeah, there was a classic JP Morgan sell-off Monday morning.
Yeah, I was just looking at that.
And you can look at JP Morgan and you look at their history, and they've gotten a lot of trouble for this. And I'm not saying they did anything wrong today, but I can always tell on a Friday uptick to a Saturday, Sunday that there's going to be a Monday sell-off, and sure enough, there is some profit taking. But overall, I think that people are they're looking for alternative currencies. They don't feel comfortable in bonds as much as they're paying that rate. They may have some money there, but they're really looking for a safer, better return. And so there's just this massive demand for gold. And this year has been really unique in gold in that the amount of central banks selling has been so low. Mm-hmm. I mean, every year you typically will see some countries sell a little bit, but this year it's all buying. They're all buying and holding. So I think they believe that we got a few years of a bull run. And typically gold bull runs last a few years. If you go back to 2008, 2009, gold went on a pretty massive 3-year run. Silver did too. So it's an interesting market right now. And I think people just don't believe the government statistics, as you mentioned. They're moving away from traditional assets. Yeah. And that's the only reason I could see. I mean, Bitcoin, I think makes a lot of sense because there's a lot going on with Bitcoin right now. I mean, they have the potential ETFs coming in January. There's like 6 or 7 ETFs that they believe will be approved. Plus there's the Bitcoin halving next year. So there's a lot of stuff happening there. But overall, I think the premise behind people investing is they just believe that the dollar eventually is just going to be gone, and they want to be prepared in different currencies.
Yeah, no, I mean, I agree. I mean, that's clearly obvious from, what you're saying happening with gold, with Bitcoin, even in the marketplace. I think, people, even despite the high interest rates, people don't feel that comfortable in, government securities. They are finding any reason whatsoever to try to move into, some other asset class. And, I think that what you're saying makes sense. There's still some people that say, I was just reading a Fox Business article today that, we could be looking at, a recession. Some people giving it 50-50 coming up in 2024, but who knows? I mean, with the way that the government changes the definition of a recession, I would not be surprised to see that, some of these numbers that we're getting from the government may be cooked a little bit. And that may be able to explain some of the differences between what the government is saying in regards to the economy and what consumers are feeling. Okay. But yeah. I guess as of right now, it kind of seems like we're in kind of this waiting period to see what's going to happen in 2024 with all of the volatility in the world in regards to potential war, Ukraine, Russia, Israel, Palestine. I think, again, when you're seeing gold rise, Bitcoin, I think people are saying that, look, we need to get into, assets that I think that we trust a little bit more than, the dollar and some of these other, kind of government securities that, options that are out there, even though they may seem like attractive investments today. So with that being said, I mean, that's essentially the gist of what I wanted to go over. Is there anything else you wanted to touch on?
Well, and not to be a conspiracy theorist, but I am. And so I just wanted to say that another thing to think about with interest rates of bonds is that, let's say a bank pays 5% or 4.5%. If you think about it, it's great for the government on two levels. One, they're able to get some money back into bonds and get some money buying their debt. But the other thing is that debt has tax obligations.
Mm-hmm.
So it's like a win-win. I don't think people realize that. And then also when you look at 5, what's really 5%? It's actually like 3%. Right?
Yeah. When you get, Unless
so it's
municipal bonds, but
right. Unless you're in muni bonds, right? And not everybody's, sophisticated or probably should be in municipal bonds because there's risk with those. There's more risk in those than your typical bond. By the way, I'm invested in a lot of things. That is one of the things I am invested in. But the beauty behind gold and silver in an IRA is that all that compound growth that you don't have to pay taxes on. And I think that's a really good thing about the IRA. The IRA vehicle, it's got its negatives. I know 401ks, they have their negatives, but compound growth is a really powerful tool. And I believe that, we're seeing this happen with a lot of our clients is that, they believe that, gold's going to hit 2,400, 2,500. They're buying gold, they're buying some silver. And that's the thing with silver being so volatile. That's the nice thing about an IRA. Like silver's at $25 today, let's say, give or take, right around there. If it doubles and it hits 50, a logical person's going to go, you know what? I want to take some profit. Even if it hits 40, even if it hits 30, you want to take some profit. That's the nice thing about our IRAs is that you can take that profit, go back into cash for a minute, see what you want to do in the market and pivot, but you don't have to pay that tax.
Yeah.
And that's the beauty behind it. Whereas these bonds that a lot of people are keeping in these savings accounts with all these big companies, there's some big tax obligations out there people aren't going to be aware of. They're going to think, oh, I made 5%. But then at the end of the year, when you're having to pay that 2% back on what you made, it actually does eat away a lot of your profits. So that is something to keep in mind too. Part of the game in growing wealth is using the tax vehicles and the tax deferred vehicles that are available, because those can be so powerful. And people in Bitcoin, they learn those mistakes too. It's great if you double your money in Bitcoin, but then when you sell it, that's a pretty big tax bill. But if you do Bitcoin in an IRA, like what we offer, you can avoid that tax bill. So it's about profit, but also having some tax planning and prepared so that when you hit that big home run, you don't have to give all that money to Uncle Sam.
Yeah, no, I mean, I think that's some pretty good advice. I mean, when you're looking at, before tax accounts or maybe after tax, Roth IRA, if you're trying to, make some gains, and you're thinking about what to invest in, you say, okay, well, if I invest in an IRA, whether that's equities or precious metals, gold, silver, whatever, you can trade in there and you don't have to worry about paying taxes unless you decide to take the money out, then, it's taxes, income or whatever. But, otherwise, if you're talking about holding, even a CD or, bonds in a bank account and a taxable account, you're looking at having a tax bill, which again makes that investment less attractive when you look at the taxes, when those gains are realized. So, I think you make a good point there. And, when you're looking at, potential investment options, the volatility going on in the marketplace, the volatility going on in the world, historically speaking, gold has always been that safe haven. And what you're seeing now is kind of the, some money moving into gold because there's going to be some things happening and you want to be in, an asset that has stood the test of time, so to speak, and having a protection of, being in that asset that has stood the test of time, plus a, tax saving vehicle can be, it can help supercharge your wealth building. So I think that you brought up a good point there. A lot of people don't really understand the tax advantages of being able to trade in an IRA or a 401k versus, having just a normal regular brokerage account, or, collecting money in, a bank account or whatever. So I think you brought up a good point.
Yeah, and also now that at later in your life, when you have to take the distributions, the RMDs, they call them, required mandatory distributions, gold and silver are unique in that you can actually take it in the metal. You can do it either way. You can liquidate back into cash, or you can take it in the metal. So that does give you some flexibility. If you don't want to be just sitting in cash, you can, when you have to take your distributions, you can take some of that gold and silver as your distribution, put it in your safe, and sell it at a later time. So there is some unique things about gold in an IRA that are different than any other investment. You can't do that with real estate. You're not going to take your stock certificate out of your IRA in Ford stock. In theory, you can. I think legally you can take it, but I don't know many people that do that.
You don't want to lose them, that's for sure.
Yeah, you don't want to lose those. Exactly. So you're not going to lose your gold. At least I hope you're not. And, put it in a safe place. We could store it for you if necessary. We have a segregated depository that we store metals in for clients, and it's safe and secure and insured. So yeah, I appreciate coming on. Yeah. If anyone's looking to just get some information and get the ball rolling on learning on this alternative asset, they can definitely check out our website or give us a call, and we'd be happy to send out some free information.
Awesome. Well, again, Mr. Plume, I want to thank you for coming on the show. You've basically done this every quarter. I think this is a great conversation that we have, just updating people on what's going on. I think it's like the perfect timing, honestly. And I'm really, really, really thankful that you do come on the show and you talk about the economy, you talk about what's going on, because I think people do need to kind of understand what's going on and what to look forward to in the future, what to look out for, and how to basically protect yourself from some of these, potential volatile situations that happen in the world and happen in the marketplace, especially when you're talking about trying to build wealth and to retire. So I really appreciate that. Thank you so much. Let me know what you guys think. Make sure you like, comment, and subscribe. Most importantly, share a Black Conservative perspective. Peace.